Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Okay, hello everybody. Welcome back to another episode of Show Me the Money, Unlocking Property Finance with your hosts, myself, Sharma, and Marc Champ. Thanks for joining us, everybody. And Marc, great to be doing another recording. Let's go straight into it. So we thought today would be a good opportunity to just talk a little bit about changes in the market and what we're seeing in the lending space. So Marc, I guess this is a great one for you. This is your bread and butter. So let's kick off the conversation. How are things going?
So over the summer, it was very slow. And it's always slow over the summer because people go on holiday and all that sort of stuff. But I really felt that the economy was playing its part in that slowdown. So all the stuff that's been happening over the last few years was finally catching up with everybody. And I believe that was the market just saying, we need to have a little bit of a correction here, and we need to slow everything up. And I really did see it slow down. It was quite concerning. But this week and last week, we're seeing an increase in activity. And that's not only an increase from the customers coming with new transactions, but also the activity of the lenders. So we're seeing lenders moving their rates down slightly.
Oh, that's interesting.
Yeah, obviously base rate's gone up, but well, not gone up. It's probably going to go up. But we're seeing the lenders in the specialist space come down slightly. So people like Landbay, Paragon. So the buy-to-let lenders in that space are correcting it slightly. They're coming back down a little bit of a price war. Aldermore are very similar in price to Landbay, and I suppose the landscape looks a little bit more positive.
Very interesting. I mean, I guess for context, for the benefit of our listeners as well, we're recording today on the 18th of September 2023. So I guess changes you've seen have been probably in the last couple of weeks, which is basically since beginning of September. I mean, traditionally August, sort of end of July, August is normally a very quiet period in the property market anyway, relatively speaking. So how would you say that sort of that uptake in activity compares to the relative uptake you see, between August, September in historical years?
Well, it's a good question, because if you think this time last year was when Liz Truss was doing what she was doing. So
the lettuce, yeah.
I think you have to sort of eradicate what happened last year, because for most people, we just fell off a cliff as soon as she did what she did. It went completely wrong. But this time last year, again, we actually picked up quite a lot, and the activity increased, which was different to most people. And I think that was a mixture of our marketing and things along those lines. But if you look at previous years, I just don't think it's been as slow over the summer. So the increase hasn't been as noticeable. But it's probably getting back to normal levels now, I would say. So there's been a bigger increase because you're starting from a lower base.
Very interesting. And do you think people are seeing more deals out there as well then, which is obviously motivating them to go out and put their applications in for finance? What are you seeing amongst your clients and customers?
Well, I think a lot of people are still having the problem with high land values, and people aren't able to necessarily get a discounted price on land or properties they want to reconfigure. So it's quite a difficult scenario. But what I am seeing is people thinking, well, the market's stabilised somewhat. So these are times when they should be doing things. They're maybe looking for opportunities, so they're on the hunt. and have been so frustrated over a number of months and not being able to find anything, they're now saying, well, it's stabilized a bit, so maybe this is where the market's at, so we should be progressing. But we're not seeing as many below market value deals at the moment, even though I think insolvencies I read today have gone up to a record level. And I think that will continue as the stress tests really do hit in, and the remortgages are harder to come by.
Yeah, I've been reading a lot of commentary from a lot of other people in this space. And the gut feeling tends to be that actually, just looking at all of the leading indicators in the economy, the sort of macroeconomic indicators in terms of employment or unemployment, wage growth, inflation, energy costs, swap rates as well. I guess we've seen a slight, quite significant movement downwards in the last sort of week as well, which obviously has an impact on mortgage rates. Yeah, it's quite interesting because I think, but the general feeling is that we're still going to see a lot more pain and activity or opportunities for people to sort of get in the market and do deals over the next 6 to 12 months. However, there's still that quite a big gap in terms of the cost of finance to make those deals work. And I think, as you said as well, we're not really seeing true sort of vendor acceptance of some of these corrections. So it's probably going to be more of those distressed situations, which are obviously going to present the opportunities. So that's interesting to hear that you're saying you're not seeing a huge amount of movement in terms of prices. But let's talk a little bit more about the types of deals that you're seeing from lenders. Are you seeing changes in the types of products being offered? So, in terms of single buy-to-lets versus HMO, serviced accommodation, on the term lending side?
So, with regards to just vanilla buy-to-let, we're not seeing a lot of that. There's hardly any of that comes across our desk. There may be a refinance of a portfolio, but nobody we see really buys single asset buy-to-let. It doesn't happen. I think probably, again, a year ago, we were seeing a lot of people buying terrace houses and turning them into HMOs. We're seeing less of that as well. And I think that's just because people they can't get the deposit together and they're worried about the exit, about getting their money out. So the investor finance that they're taking on, they can't guarantee to get that investor their money back. So it makes it more difficult. Serviced accommodation, I would say I think it's a bit of a fad, serviced accommodation. We saw a lot of people, again, probably about a year ago, going into the serviced accommodation, and I think it's not done quite as well as people expect. You can get these high night rates for serviced accommodation, but then when you get the voids and you've had a whole year of trading, it sort of evens itself out. So it's not much more profitable than buy-to-lets. And I'll stand corrected if people tell me otherwise, but we don't see a lot of people coming in with serviced accommodation requests because the lending rates, the interest rates for lending is more expensive if you're doing serviced accommodation. So that erodes some of the profit. You've got the management costs, you've got other things. And for me, I reckon the net profit you would get isn't going to be massively more, but it will be more labour intensive. So I think what people are looking for are the opportunities, but they're not necessarily coming as quickly as people want. So they're having to maybe settle for less profitable schemes.
Yeah, interesting. And I think that point you made as well about the operational costs in particular, when you're running things which have a high turnover, such as service accommodation, holiday lets, etc. You've got to have some really slick operational processes to make that worth your while. It's not something I've got an exposure to, but anecdotally, it's quite interesting to hear what people have experienced, and I think you've highlighted some of that quite well there.
Well, just on that, thinking about it, if I look at my customer base, none of my highly experienced customers do serviced accommodation. So I don't know if that's because they're just stuck in their ways or because they know something that puts them off doing it. So yeah, none of them. I can't think of one that does serviced accommodation. People who are new to the industry, yeah, we get inquiries, but my people who've got big portfolios, they're never saying, "Oh, do you know what? I want to buy this because I want to do it serviced accommodation." Never happens. So maybe
Yeah,
that tells the story.
indeed. We'll talk about bridging and development finance in a minute as well. But I want to just pick your brain a little bit more on what you're seeing with the lenders. What are you seeing? So we're seeing a slight reduction, I guess, in lending rates or sort of the product rates themselves. What about the product fees? And how are the sort of 2 versus 5 years comparing, which will marry the swap rates to an extent as well.
Yeah.
But yeah, what are you seeing there?
So yeah, obviously there's the option that you could have a higher interest rate and a lower fee. So I don't know, something like 6.49 with a 2% fee, or 5 point something with a 5% fee. And it usually is more advantageous to take the higher interest rate and the lower fee. It usually works out more cost effective over the long term. We have got one lender who actually will do a term product where you can borrow with a 2% fee and have early repayment charges, or borrow with a 3% fee and have no early repayment charges. So it's quite a handy tool that's available there. But there's something I did notice last week was a new loan coming out with a 9.99% fee. And that, you think it's a 10% fee almost on a buy-to-let.
That is high.
That is high. Lower interest rate, but you're paying 10% up
Marc,
front.
sorry to jump in. Are you able to your audios? It's gone a bit funny for a second there.
Okay. Is that any better for you?
Perfect. So tell us more about this 10%, this almost 10% product fee.
Yeah, 10% product fee, low interest rate, or relatively low interest rate. But yeah, you've got to pay a 10% fee up front, which seems crazy. If you think about where we were 18 months ago, and somebody said, right, you're going to be paying, I can't remember the rate. I only saw a headline of it. A rate with a 10% fee for a buy to let, you would be shocked. And I'm even shocked now. Whenever I see a rate card of a buy to let lender and it's got 7%, I don't know. I don't think any of my customers have gone for the 7% option for the fee.
Yeah,
10% fee, that just seems massively over the top. But we shall see.
It's quite dangerous as well. Yeah, as we spoke about on a previous episode, you just add it to the loan, and then like when it comes to refi or rate switch, you're going to be at a very high loan to value because of that additional fee that you sort of stuck on. And if there's not been much capital growth, then yeah, that sounds dodgy.
Yeah, and I haven't read the small print on this, so I don't know with the 10% whether you can add to the loan or not.
Yeah.
But if it is the case that you can, yeah, that would be a bit over the top in my opinion. So
what about loan to values? There was a period when we were seeing a lot of sort of 75, 8, and even 80% loan to values from a lot of lenders. Where are you seeing LTVs at the moment? And anything near what it used to be?
Yeah, most lenders are still at 75%, and there's a couple at 80%. Hasn't really changed so much. I think there's one of the places that we've seen things pull back on is the commercial space. So commercial properties, it's hard to get a loan on. We had one, it was only a really small owner occupied deal, and we had a look around the market, and then you've got the likes of Alaka, Interbay, Shawbrook, who do commercial, for instance. But it was all too small for them. And if you've got a small lending request, there's only the high street who really will do it. And to be honest, with the high street, I went to 3 of the high street lenders. Not one of them replied to me. So I don't know if it's just me, but it could be the customer service isn't the best there, and I'll get a response in a week or so. Who knows? But there's nobody who really likes the small commercial investment properties. And the only one we really found, there was Ortus, who do a 36-month term, but they're on bridging rates. So there's not a lot of options out there really for smaller commercial investors at the moment, which I think it's difficult for some people. And also, Shawbrook have even stopped lending on retail; they won't do any.
Wow. Yeah, that is interesting. And are they reducing their sort of loan to values as well on the products, or is it just a smaller range of products actually available?
So smaller range of products, and generally 60-65% is where they're at. And it used to be the case that you could push that a little bit, so go up to 65-70, but now it really has come off. And if there's a quirk in the transaction, loan to values are hit readily. So it's hard. It's hard to get the commercial deals over the line at the moment. Even the bigger ones are tough, but the small ones are really, really difficult to place.
Yeah. So overall, when we look across residential and commercial borrowing on term loans, mortgages, where have you seen the sort of sharpest? Probably early to say, but where have you seen the biggest change in activity?
It's
biggest
strange.
increase? What's hot?
I
What should people
suppose
be looking at?
even though I've just said commercial is really hard to place, we probably see the most activity in the commercial space where people are trying to buy commercial and change it into residential. I've noticed also there's a lot of the property training companies offering commercial conversion courses, and that seems very popular at the moment, where people think they can just do it because of the potential that you won't need planning permission to do it, and just get straight in there, even though it's a lot more complex. So I would say that's probably where we've seen the highest level of inquiries, and also refinances, just people just wanting to make sure they're on a rate that is sustainable for them, and they don't want the rates to go up anymore. So we are seeing people fix in now that they think it's sort of getting to the top of the market, because they just don't want any more scares or surprises. We're seeing quite a few refinances, but there is a lot of activity come the last week or so.
Yeah. Okay. So very quickly then, let's just talk a bit about what you're seeing in the bridging and development finance space. Are you seeing any changes in lender appetite, new types of products, changes in the rates there as well? Obviously, we know that bridging and development finance rates are not linked to the base rate as such. However, the risk-free rate is always a consideration. But yeah, what are we seeing in that space?
Well, we're seeing a lot of the bridging and development lenders move to a base rate linked product. So if you look at the likes of Octane, the rates that they give out are always a certain amount over base, whereas previously it used to be more of a fixed rate. So we are seeing more of that. Generally, it's around 1% a month. We are seeing new products come out. We've seen Avamore launch a new product today. They launched another one a week or so ago. And these products are designed to help people with development exit issues, and we're getting a few more inquiries on that as well. Development exit, people who just need an extra, I don't know, however much to complete the development, and they're looking to get a top up or to actually move on to a different product. So rates have stayed where they are for a few months, I suppose. Now they've not jumped up too much on the development space, but they are obviously a lot higher than they were. And I was talking to somebody at one of the high streets on Friday, and the high streets used to be all over development finance. They used to be, I remember going back to Lloyd's and talking to them about 5.5% for development finance. But now we just don't hear about them doing it. It's they're not coming out and saying, "Oh, what development finance deals have you got?" It just seems it's non-existent. So choice is, I suppose, more limited, and I would say the actual developments themselves is harder to make a profit. But hopefully the costs of build have stabilized somewhat, which makes it easier for customers to get some profit out of it.
Let's see. I'm keeping an eye out on deals, and still difficult to make them work, but they are out there. We've just got to grind the wheel a bit harder to try and get some output from that.
Exactly.
Very good. Any other sort of general trends or observations from what you're seeing in your line of work as well? And congratulations on your recent award. I saw that.
Yeah,
tell us a little bit about that.
Yeah, that was a surprise. We were nominated for 4 NACFB, which is the National Association of Commercial Finance Brokers awards, and luckily we came away with 3 of them. We won Buy-to-Let Mortgage Broker of the Year. I'm just looking at the trophies now. Industry Ambassador of the Year, and Deal of the Year, and that was a nice development finance deal we did last year, and really happy to come away with them. It's we put a lot of hard work in and try and look after our customers, and the industry has recognised that. So I'm really grateful and pleased to have won those.
Brilliant! Great, congratulations again. That's fantastic. And I guess it's the great thing about those events is always that you also get to hear about what else is going on in the sector from your peers. Anything else you've picked up on from some of your peers in terms of what they're seeing? Anything that perhaps you've not picked up on yourself or not come across, or anything which you think will be useful to listeners?
Trying to think if there is anything. I can't think of anything off the top of my head, but maybe I will have a think, and then next time we meet, we'll I'll see what I can pull together.
Sounds good. Well, I think that's been a really helpful update for everyone. So we'll keep up with these regular market updates as well. We'll give everyone the insights which Marc is seeing at the coalface. And if you've got any questions or any topics that you want us to talk about in detail, including with our guests, then please do leave a comment or send us a direct mail or post. And obviously everything, including our contact details, will be in the show notes. Anything else? Final remarks, Marc? No,
I suppose just get in touch if you would like to talk about any investment or development deals, and also trading finance transactions, because we do a lot of that as well. So keen to hear from people, and I'd love to answer questions.
The trade finance might be a topic for a future date as well. We can definitely let our listeners learn a little bit about that.
Yes,
brilliant.
Do that.
Great.
All right.
Great chat.
Thanks, Marc. Thanks.
All right.
Bye.
See ya.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.